Good morning, good afternoon. Should I just say good day? Much easier, wherever you're calling in from. I'm delighted to have you with us for this very important discussion on the materiality of nutrition. We're delighted to be working with the Access to Nutrition Initiative on this project. We'll be talking about a report that we are publishing today, which discusses the issue. And we've got a very interesting panel to discuss the points as well. We're also going to be hearing from Greg Garrett, the CEO of the Access to Nutrition Initiative, in a little while as well. So lots to look forward to over the next hour. Just in terms of a few housekeeping points, we've got quite a tight agenda, so there's a good chance we won't have time for many questions, or possibly not even any. We'll see how we go towards the end of the hour. But if you do have questions, please do use the Q&A function. We will pick up all the questions. And we will endeavour to answer them all after the webinar if we can't actually deal with them during the course of the event itself. So I should briefly introduce myself as well. I'm Peter Owen. I'm the head of Food and Land Use at Planet Tracker and also director of Fixed Income. I'm the main author of this report, but with a lot of input from the Access to Nutrition Initiative and a number of other people credited in the report. And we're just delighted to have a number of really significant contributors to this webinar this afternoon. In particular, our keynote speaker, Emmanuel Febet, who is going to be speaking in a moment. And Emmanuel, of course, was appointed as the inaugural chair of the International Sustainability Standards Board in December 2021, took up his post in January 2022. And at the end of last year, the ISSB announced that he was going to serve a second 3-year term starting on the 1st of January 2025. So we've got Emmanuel in a very significant position for a number of years to come, which is absolutely fantastic. Now, of course, he's well known as somebody with a passion for sustainability and leadership in multinational food products company Danone over the past 20 years. He joined the company in 1997 as Chief Financial Officer and served as its CEO from 2014. So he's got a lot of expertise in the area that we're focused on in terms of our report, nutrition and the materiality thereof for financial markets and companies, but he's also got a lot of experience in the broader sustainability debate. So I'm delighted to welcome Emmanuel and to hand over the floor to him for our keynote address. Emmanuel, over to you.
Thank you, Peter. I just want to ensure, can you hear me well? And see me well as well?
Hear you and see you, thank you.
Okay, great. Well, it's a pleasure for me to join your webinar today for all the reasons that in too many ways Peter has mentioned, both as a passionate advocate for nutrition for 20 years and now doing some more systemic work on sustainability disclosures. And of course, there's a connection between the two. I read Peter's and partners' report on the materiality of nutrition, and I'm very pleased to offer maybe just a few, views before you start that webinar. First thing I would say is that ATNI is a very important initiative. We at Danone were critical partners for this initiative. We've been supportive. We've been using ATNI. I know the company continues to use ATNI, including as a way to measure its KPIs in progress on the health particular aspect of the mission of Danone as an entreprise à mission, as we say in French. So having said all of that, I really found interesting the analysis of the materiality of nutrition report. And this is not the first time, of course, that in particular with the company switching to gradual, better for you nutrition portfolio, we have asked ourselves this question about the valuation of that move. And if there is one conclusion of the report that I share, is that this is a very blurred conclusion that we can have. If economics were as true as some part of the analysis is showing, I don't think ATNI would have needed to exist maybe, and I don't think this webinar would be so important at that critical juncture. I think maybe the economics might work, but for a number of reasons, they don't today. And again, we would not be having that discussion 10 years after the launch of ATNI if that had been fully the case. So yes, of course, the hidden costs of malnutrition are obvious, but they are not paid by companies nor investors. And it looks like there is not enough perception of the risks and nor the opportunities that are lying under the potential strategies for the private sector to address nutrition topics as part of their strategies. I guess my attention was really caught by this sort of specialist interviews of 5 investors in the report, because I think I can really relate to their conclusion. One, regulation is going to be key to drive the changes required. 2, consumers won't drive change on their own due to what the quotes of investors were describing as an obesogenic food environment in which they are required to make their purchasing decisions where they shop, basically. 3rd, investors have an important role to play, and I will come back to that, of course. But the question is, why don't they play it more than they do today? And I guess another important aspect is the notion that better disclosures would be essential to enable financial markets to assess the costs, risks, and opportunities. And this is what at ISSB we are working on. So let me start maybe by, from those conclusions, say, first and foremost, regulation is going to be key. I've been supported by the notion of consumers changing, millennials and more educated consumers. I think it won't happen at the scale at which it needs to happen, and actually touching the right persons in terms of numbers for the market basically to rely on market forces and consumer driving that change. And this is why regulation is key. So regulation have been, for instance, in Europe, we were part of some work at the EU level about the 2011 healthy aging mission that was about 2020. On the 10 years from 2010 to 2020, on 10 core measures for healthy aging, 4 of them were identified as being related to food. And so there is no doubt that from a policy standpoint, nutrition matters. In the same time, I have to say that nutrition and that change in food habits is probably one of the biggest drivers of change for a climate just transition. But it's also probably the most difficult one, because we are really talking about changing habits of one by one purchase on the shelf consumption in a specific local cultural environment. And this is really hard. I would remember for long the experience of the regulation put in place by Mexico in 2011 as well, or 16, sorry, when they introduced the sugary beverage tax. I remember the conversation I had with the president of the ConMexico, the FMCG association, that shared 3 years later, and we were part of all of that, how actually in many cases in the lower income, the consumers had continued to pay an overpriced sugary beverage because they wanted to offer the right socially acceptable brand for their kids and the friends of their kids, as opposed to cutting then on fresh food and vegetables. So again, the notion that regulation can easily fix the issue, I think, is something that we should be very cautious about. So of course, then better disclosures are essential. We are developing an accounting language for sustainability. We started with climate. We are now going to human capital, to nature and biodiversity, just transition matters. But also we have SASB standards that cover, including food and beverage and agriculture. And it is quite likely that in those particular industries, those sector-specific standards will incorporate topics that are related to nutrition and the cost for society. But even because there is a cost of society, then the risk for companies that one way or the other, they will have to face and share some of that cost. The strength of our accounting language compared to the financial statements or the IFRS accounting system, which is in place in 140 different countries, is that first, we require companies to look at all their value chain. So it's not only the very specific part of your own operations, but all your value chains, including therefore consumers, including agriculture on the other side. And the second aspect is we require to be compliant with SSB standards. Companies have to report on the short, mid, and long term. Short, mid, and long term. This is a requirement. And the connection with the financial statements, anticipated or current, is also required. So it's pretty structuring in terms of opening to the risks and opportunities that are there underlying on nutrition, malnutrition, obesity, diabetes, and all other sort of issues that are related to nutrition that might give rise to the risks of taxes to come, regulations to come, like the sugar aspect in the European Union, for instance, but also industry movements that will be created. Having said that, the materiality aspect of it will be critical. And we have made a conscious decision to really focus on financial materiality, which is a materiality that assesses the risks on cost of capital, the opportunities on the returns, and therefore, and again, this is not entirely capturing the materiality of nutrition on society, other than if it can reasonably be expected to have an impact on the prospects of the company. I think that if you take this into account, and I will finish with that, I'm back to why investors matter and what do they do? Because today they don't do much. Yes, there is ATNI, and ATNI, we've been pushing ATNI, a lot of us. And ATNI, I think, is a great achievement as a potential metric for investors to look at. The more companies will be robust about their ATNI declaration, the more there will be data that investors can feel is reliable enough for them to make decisions. But if I think about who is going to ultimately first support these systemic risks, I'm thinking about the ATNI community and yourselves as you're part of this webinar to think about going and talking to first insurance companies, because at some point in time, they will have to pay the cost of diabetes, of obesity, and other critical nutritional or malnutritional aspects. I would be speaking about pension funds that one way or the other will have either a risk or an opportunity, depending on the actual net present value of the risks around malnutrition and the morbidity risks and mortality risks. I would be speaking to sovereign funds like GPIF or Norges that are looking at the next generation investment return in 30 or 100 years, like is the case for Japan with GPIF. I would go to the banking system and the long-term capital holders, like, for instance, sovereign bond holders, because if companies don't pay, ultimately states will. And therefore, the cost of debt for the states, anytime an investor is buying a sovereign bond from a country that has major obesity problems, that there is an inherent risk in that bond in the long term, 30 years from now, about obesity and the productivity on the workforce and many other issues and costs for society. So I think instead of speaking to the shareholders of the companies themselves, I would also, which I would really engage a coalition of willing of companies, those who have a deep interest in ATNI, and I know there are a lot, to continue, of course, to do this. But what I would do as a more strategic approach for the nutrition passionate crowd around NGOs and policymaking, and of course with ATNI, I would go to those long-term sovereign insurance pension plans because they have a very specific materiality aspect in the way their performance, their mission will be affected by how nutrition is being taken care of and dealt with by the private sector before it becomes an issue for the debt, the deficit, and all the disbalances that can be created by this ramping topic. I will stop here. I just want to say that I can see that on climate and on many other things today. We all know that the political consensus are increasingly volatile. I therefore would not rely too much that regulations will come. If they do not have a very clear economic reason, a materiality reason, I will not repeat what I said. This is an encouragement to go in those directions. But finally, I think at the end of the day, this is a matter of leadership for all of us around this call. I think more than ever, the ATNI coalition of willing is critical on this topic. So thank you for inviting me to start your day and your webinar. It's been a pleasure to be reconnected with this great crowd, and I wish you all a very successful and fruitful discussion. Thank you.
Thank you very much, Emmanuel. That was an excellent keynote, and I think it suitably sets up today's discussion on the materiality of nutrition. You clearly referenced that ATNI exists, and we're here today because we haven't actually put all the answers together on this, and that markets are not incentivizing healthy foods. And the good news, however, and I think what we're going to see from this report is that answers are starting to emerge. And also to your point about sort of the non-traditional players, we have on our panel representatives from insurance, from pension fund holders and investors as well. So I lead the Access to Nutrition Initiative, ATNI. We're a global nonprofit, and we commissioned this report with Planet Tracker because we know that after 11 years of very deep experience working with corporates, that when we measure company performance, we're seeing that markets are simply not incentivizing nutrition. We're not seeing that improved access to healthier foods that we would like to see. And we need to move from the simple, I would say, macroeconomic arguments for investing in nutrition. They're important, and they've been made very strongly, and they're great for policymakers. For example, for every dollar you invest in nutrition, you have $16 in return. That's important for society. That's important for economies. But what about the short to medium term returns for businesses and investors investing in nutrition? And so we really believe at ATNI that if we're going to ensure that nutrition and healthy foods are integrated into food systems and are not sidelined as something only the wealthy can afford, or that donors or charity help pay for, we must answer this question of material issue. Is it a material issue? So therefore, markets need to incentivize healthy food production. This report is really trying to answer two questions, and I'll let Peter explain the findings. But firstly, the first question we wanted to uncover is, are companies who have transitioned to healthier food portfolios finding better financial opportunities and higher valuations on capital markets? The second part of our thesis going into this was that the growing regulatory requirements, which Emmanuel also mentioned, and that we're seeing not only in Europe, but also globally, especially in emerging markets, those regulatory requirements related to nutrition does increase financial risk to companies and investors and to insurers, for example, who are not, and so therefore companies need to shift to healthier foods. So we believe that financial risk is real, and we think that we might have some findings to show that. But before we ask Peter to provide the findings of the report, there are three important themes that have emerged while we've been doing this. Firstly, disclosures are absolutely critical, and standards are necessary. We need all food companies to disclose the healthiness of their portfolios, and it has to be done in a uniform manner. And it's not currently being done with standards that we would all agree are the best standards. Secondly, nutrition must be fully integrated into the performance reports and investor dialogues. Emmanuel, you mentioned the 5 interviews that were done with investors. And what that uncovered, and what our own experience has been working with over 80 institutional investors, is that nutrition is not fully integrated into these investor dialogues yet. It's not necessarily part and parcel of all the performance reports coming from companies yet, and it must be. And then thirdly, there's a tremendous opportunity for sustainability reporting frameworks to introduce standards on nutrition and ensure that it's part of these company performance disclosures. So for example, the European Sustainability Reporting Standards, or ESRS, we would hope would over time include nutrition standards. So this report is only the start. ATNI has identified 4 next steps following the findings of this report. So the first one is that we're proposing to embed very simple nutrition metrics into sustainability reporting frameworks. We're already trying to do this in India with the BRSR. We'd like to start working on Europe's ESRS and other frameworks that are coming on board around the world. Secondly, we want to ensure that food company accountability on healthier foods is something that is routinely looked at by the executives and the boards of companies. We believe this can be done through increased investor pressure, and we're already working with over 80 institutional investors on this agenda. Thirdly, ATNI wants to support activities that increase access for low-income consumers in emerging markets. Because what we're seeing is that there could be a proliferation of modern food retail in low and middle income countries and in emerging markets. We want to make sure those markets are not flooded by unhealthy foods, but rather people have access to affordable, healthy food products that are convenient. And then lastly, I think what this report's really taught us is that it's only the beginning. We need to uncover more answers. We have, as you'll hear from Peter, uncovered a loose association between healthier food portfolios and valuation of those companies. But we really need to show even stronger evidence of causation if we're really going to improve markets for nutrition. So thank you very much. And Peter, over to you. Yeah.
Thanks very much indeed, Greg. And also thank you to Emmanuel as well for a really interesting keynote speech. And it was fantastic to hear him blend together his experience from the food industry with his current role in the ISSB, and clearly more to come on that score. So what I'd like to do now is just briefly run through the findings of the report, the project that we've just been through with Access to Nutrition Initiative, and talk you through some of the findings, some of the results that we've come out with, some of the conclusions that we've drawn, and then I'm going to throw it open to a panel discussion, and I'll introduce the panelists when I get to that point. But first, just to sort of talk about the report itself. And by the way, it will be published 4 o'clock this afternoon UK time. So just after this webinar closes, it'll be available on the Planet Tracker and ATNI websites. And we will also be emailing links out to it as well. So you'll be able to get hold of the report itself pretty quickly after this webinar. So the key things, as Greg said, what we wanted to test was the extent to which health is wealth. Are companies that are focused on healthy foods and healthy food sort of product portfolios actually making more money and being rewarded for that by the financial markets? Or is the sort of, if you like, the prejudice, the assumption that many people make that actually selling bad food that's cheap produce, expensive to sort of sell, very high margin, is bad food actually best for financial returns? Now, we looked at 20 public companies. The ATNI Global Index covers 25. 5 of those are not public, so we focused on the public ones because then we can get financial and valuation information for them. They covered a total of over $6 trillion US in 2022. That's about 10% of the global food and beverage market. So a small number of companies, but because we were picking the big ones, a really significant slice of the market. Now, the sample size itself is small. I'll talk about that in a bit more detail as we go through. And of course, correlation does not prove causation. So we've shown some linkages, but I think it would be arrogant to say that we've provided definitive proof in this report. And as Greg was saying, almost certainly more work would be worthwhile to sort of dig deeper into the issues. Now, to sort of try and handle the companies more usefully, we faced a bit of a challenge because although there are only 20 of them in the group, they're quite a diverse population of companies from a number of different countries and operating in a number of different ways. So We stratified or segregated our universe into smaller samples. That increased the sample size risk, of course, but it gave us a much stronger like-for-like comparison. And you can see that we started by dividing by size. We then divided into food product portfolios. Some of these companies have lots of different sort of products that they're selling, soft drinks and coffee and baked goods and all sorts of things like that. Others of them are much more concentrated on, for example, just doing soft drinks. So we divided them into sort of narrow and broad food product categories, and then we divided them according to the assessment of the healthiness of those food portfolios based on the ATNI health star rating scoring system. And we took a level of 2.3 out of 5 as unhealthy, and more than 2.5 or 2.5 or more as being healthier. We haven't called them healthy because healthy would be 3.5 or more. So broadly speaking, only one of the companies in the ATNI index is scoring 3.5. That actually is Danone. The rest of the companies, unfortunately, well below that healthy benchmark. Now, what did we find? Well, we found firstly that companies that are focused on broader food portfolios, so they're selling more products, certainly the smaller ones, there is a reasonably clear linkage between healthy products and being more profitable. And you can see from these charts here that when you look at the small, broad, healthier companies, the second green bar on the left-hand chart, it's significantly ahead of the red bar. And if you look at the right-hand side, you can see that that applies over time as well. So those healthier companies with healthier food product portfolios, consistently higher margins. That's much less clear when you look at the larger companies. And in fact, here we enter the sample size challenge, because realistically, we're actually comparing simply two companies, one with the other, and that's actually Unilever and Nestle. And you can see that over time, they swap places from a margin perspective, and the difference between their margins is much less slight. Now, clearly, these are very large companies and there are lots of things going on within them. So worth adding that we did actually check. Unilever clearly does many other things than food, and we did actually look at the margins from the food business as well when we were doing our analysis. You can read more about that in the report. So first simple takeaway, small companies, broad portfolios, they're getting paid more, or they are earning more by selling healthy food products. So that sounds pretty good. Unfortunately, when we look at companies that are really focused on a few products, we find that focusing on a few unhealthy products seems to be more rewarding than focusing on a few healthy ones. Now, the sample here is very dominated by the large soft drinks manufacturers like Coca-Cola, Dr. Pepper and Pepsi. And clearly that is their sort of their main raison d'etre, is making essentially an unhealthy food product and selling a lot of it and making pretty good margins out of doing so. So that runs sort of counter perhaps to the outcome that we were rather looking for. Focus on unhealthy, keep it narrow, just concentrate on that, and the margins are pretty good. Now, of course, the challenge with that is that these are the companies that are going to be the focus of regulation. And so there you have the regulatory risk that Greg was talking about. And again, in the report, we go into this in a lot more detail to look at the regulations that have been tried already and the ones that are potentially coming down the pipe. And if you're making very high margins from selling an unhealthy food product, then there's a very strong chance that over the next few years, and it's likely to be few rather than many, you will suffer a regulatory hit. Now, we also looked at the valuation side of things. And when you look at EV/EBIT ratios, we do find, generally speaking, that companies selling healthier food products are being rewarded to a greater extent by the financial markets. The financial markets are giving higher valuations, not dramatically so in some cases, but higher valuations to companies selling healthier products. And that applies basically across the board, including in the larger company universe. However, it's worth saying that when you start looking at other valuation metrics, you do get a more mixed picture, and particularly if you look at price earnings multiples, where all of the operations of the company are being taken into account, all of its debt, all of its tax situation, all of its local differences. So on a sort of all-in measure, then actually we find none of the healthy groups show higher valuation than the unhealthy groups. So valuation, again, as Greg was saying, some positive indications, but definitely a mixed story coming out. Now, part of the thesis, as Greg was flagging, was that we are assuming that company disclosures are poor and that therefore financial markets are pretty hampered in terms of their abilities to assess the risks, which is obviously quite significant, but also to look for the opportunities as well, which is clearly something that companies may be missing when they're talking to investors. So we also spend a bit of time looking at the annual report disclosures and also the earnings call disclosures from companies. And here we can see that in broad terms, companies are occasionally discussing nutrition as a risk, but when they do, they're only doing it also discussing it as a strategic opportunity. Generally speaking, they're mainly discussing it only as a strategic opportunity, and there's a small group that are not discussing it at all, but there are no companies that are only flagging it as a risk. So you might broadly conclude when you're looking at annual reports that the outlook is optimistic. It's all about, well, consumers have got changing diets and we'll accommodate that and do some good things to make sure we carry on making money. In terms of setting targets, again, a similarly disappointing situation. 7% of the sample only report HSR. Neither is the big orange segment. 64% are not reporting any form of sort of, health star rating score for their nutrition. They may be giving one or two other metrics, some sort of homemade and less perhaps credible, but they're not reporting to an externally sort of verified model, and very few of them are setting targets. So disclosure, target setting, pretty disappointing. When you look at earnings calls, again, nutrition is often not mentioned. Now, that might not be such a big surprise. Earnings calls tend to be very focused on the short-term sort of results and the near-term sort of expectations and plans of the company. But generally speaking, a lot of calls did not feature mentioned by the investor or indeed by the company. As you can see, there's 60% of calls just got no mention at all. There were 33% where one or the other initiated the conversation, only 7% where there was some sort of dialogue. So generally it was a question with a short answer or a statement which didn't get any follow-up. So in conclusion, what can we say? Well, we think we've demonstrated that nutrition is a material issue. It's clearly driving up health costs, and I think both Emmanuel and Greg were very, very clear in terms of the cost to society and how that then will feed through to companies and to the financial markets. Employers are clearly suffering a cost from their workforces, and increased regulation is inevitable. So there's a risk increasing for corporates. Companies making high margins from unhealthy products, clearly the most at risk. And if you want to make a healthy strategy, selling a broad range of products would appear on our analysis to be a good starting point. And it's likely that you will be more healthy, more profitable as a result, and your customers will be more healthy. Poor disclosures are the key problem. So investors have an important role to play. And what I'd like to do now is to bring in our panel and throw the floor open to them. So I'm delighted to welcome Lauren Compere, who's a Managing Director of Shareholder Engagement at Boston Common Asset Management, and Alexia Howard, who's the Senior Research Analyst focused on US food companies at AllianceBernstein, and John Shunby, who is the Global Chief Medical Officer at Swiss Re. And Emmanuel mentioned insurance, John, so we'll definitely come back to you on that in a minute or two. And then finally, Frank Wagemans, who is Senior Engagement Analyst at Acmea Investment Management, and also chair of the Access to Nutrition Initiative. So let me just get rid of the slides so that we are all properly sort of visible. And really to sort of start with, I guess, the first sort of question. You've all had a chance to read an embargoed draft of the report. Very exciting. You got an early look in. Was there anything particular that caught your eye or surprised you, or maybe would you highlight as a key takeaway? Lauren, perhaps I can start with you and get your views from sort of asset management perspective.
Thank you so much. I've actually been part of Greg's journey for the last 10 years with the Access to Nutrition Index. I sat on the board, and I think what it speaks to is that, one, I think investors are always very cautious around these types of reports. But what's important here is that we've made the effort, right? The effort has been made to sort of assess how nutrition is material, what the evidence is telling us, and what it isn't. I think what would reinforce, and what I think is a really key next step, frankly, is that we need a broader set of companies being assessed across a common set of metrics. And I really like the fact that Greg highlighted that one of the next steps will be trying to embed these into sustainability frameworks. I think our biggest challenge right now, Peter, disclosure is. And so I think we need to also come around to common understanding of what healthy is. And because right now, companies have their own version of healthy, markets have their own version of healthy. And so that, I think, is a key area that we should be exploring as we move forward.
Yeah, thanks. That's a really interesting point, actually, Lauren. And I think that was something Emmanuel was touching on as well, wasn't it? This sort of need for standardization. Frank, you're sort of at the asset management end of the spectrum as well. Any views from you on what you would highlight from the report, reactions to it?
Now, first of all, I think the report is really interesting, and I also hope it spurs a lot of debate. What really struck me was that 93% of the companies said there's an opportunity in relation to nutrition, which is a good thing, which is a positive thing, but only 1/3 saw it as a risk. And I think that's kind of strange if you are especially looking at what also the reports highlights, the increasing number of regulations in a number of different markets. If you look to the outcomes of the access to nutrition index, which shows that a lot of companies have a long way to go to make their portfolio more healthy. So if you combine that, it's a bit odd that it's not flagged as a risk, and I think that's because some companies have not assessed it properly. I think partly it's also not nice to talk about it. It's nicer to talk about opportunities than to risks, but also for investors, I think we have quite some work to do to truly grasp the topic and to really challenge the companies to identify this as a risk and also present that in a financial way that resonates within the financial sector.
Yeah, thanks, Frank. I think that's a really interesting point. We were very surprised, to be honest, not to see it being discussed to a greater extent as a risk, I think, for all the reasons that you set out. Alexia, from a sort of sell side perspective, I mean, anything stand out for you in terms of the conclusions of the report?
Sure. Yes, no, it was fascinating to read. And just for background, I cover a lot of the US packaged food companies, everything ranging from Campbell's to General Mills to Kraft Heinz to Hershey. But I was also involved in setting up the original SASB standards. I was part of that working group back in 2016 that was providing input into that. So my reaction to it was that it wasn't surprising to me that there were a lot of mixed messages coming out of the margin analysis. Because there are so many things that drive margins, and you could argue that commodity basic foods are much healthier and have very low margins. So, what will consumers pay for convenience for healthier, moderately processed foods that perhaps could be branded and higher margin, but still nutritionally very robust? I thought the multiples thing was very interesting because you would have thought that companies with healthier products would be rewarded. But I think that all comes down to, can we prove that the sales growth, the underlying volume growth of healthier foods is higher? And frankly, within my coverage, the highest quality names, it's almost like a barbell. You see a company like McCormick that's associated with cooking from scratch, and therefore in the spices and herbs world, very much on the healthy side, doing well on a multiple front and considered to be a high quality name. But the other end of the spectrum, snacks, indulgent snacks have grown very well, particularly in emerging markets over time. So Mondelez and Hershey in the US also do very well. So I think it is all about sales growth. And if we could actually demonstrate and prove that healthier foods have the potential, all else equal, to grow faster, obviously better for you snacking, like skinny popcorn perhaps, when it was publicly traded. I think that's kind of the sweet spot, no pun intended. And then finally, I just thought that this concept of easier to switch out portfolios, if a company has a broad product range, it's easier somehow to switch out the products. We actually saw that with Danone back in the 80s and 90s when they were moving into baby formula and dairy and bottled water when the environmental concerns weren't as major as they are today. But it's much harder for a company like Hershey because they are known for US chocolate. They are trying to switch out and diversify by buying Amplify brands and acquiring Skinny Pop popcorn, for example. But it's much harder when the legacy of your company is all about US chocolate. I'll leave it there.
Thanks, Alexia. Yes, it's always good to bring chocolate into the mix, I have to say. But and I think your point on the sort of breadth of the portfolio and the extent to which companies can switch or not is really interesting, particularly again, going back to Frank's point from a risk perspective. If you are focused on a narrow portfolio of very unhealthy products, it's a challenge to switch, and you're going to be sort of potentially subject to regulations. So interesting points to think of. John, if I can come over to you and maybe sort of broaden the question or allow you to sort of, cover a broader range in your answer. I mean, Alexia was talking there about sort of, the benefits of sort of healthy food for the corporate perspective, but also the challenge that it's very good from a corporate perspective to focus on unhealthy foods. So your role at Swiss Re is sort of looking at, medical issues and things like that. And clearly, Emmanuel mentioned the insurance industry as one of the primary sort of movers and shakers in this context. So maybe, it'd be interesting to get your reaction to the report, but also to your reaction sort of more broadly in terms of how the insurance industry is thinking or not thinking about nutrition as a risk. So tell us what you think.
Thanks, Peter. I think the report was so interesting to read, a little worrying, considering how much money you can still make and how profitable you can still be selling really unhealthy things, I guess. Great to see that on some measures, selling healthier food is beneficial, but certainly not on all, and it is a small sample size, and as you say, it's correlation, right? It's not necessarily causation. I was very pleased to read in the report the kind of calling out the health risks of unhealthy food, right? Which is really a very big deal for Swiss Re. So most of our risk is sitting in mortality cover. So we're a very big life reinsurer. And so the longer term health of populations is key to us. And we've realized that nutrition is probably the most important thing. We've got a huge project on metabolic health. So metabolic health is typically considered the cardiovascular risk factors, obesity, diabetes, poor, high blood pressure, that sort of thing. And the science is really showing that it's all underlaid by metabolic ill health, which is insulin resistance. And insulin resistance is primarily driven by food. So food choices, and it's really interesting, it was mentioned earlier, what's healthy? And I think we don't quite know yet what's healthy. We've had dietary guidelines for 50 years, kind of following the same route. I think the science is beginning to show that up a little bit. But we know we can massively improve population health and longevity, which of course our interests are aligned with healthier populations. So we speak kind of quite purely in terms of this. And then just the final thing that was mentioned about risk. I don't understand why these companies aren't concerned about regulation, because Swiss Re, I think, quite actively will try and lobby regulation to get people to have healthier food, because it just makes so much sense, right? And if those regulations come through, then it's a huge risk for these companies selling very unhealthy foods.
Thanks. That's a fascinating point, actually, John. And I must admit, I'm not really engaged sort of properly with the concept Swiss Re will be lobbying for healthy food regulation. It makes a huge amount of sense. And there's a bit of a call to arms for investors to pay attention, because Swiss Re is not a small organization and probably gets quite a lot of attention to it paid in the different seats of power around the world. Alexia, maybe I can come back to you on sort of building on that point. From a sort of sell side perspective, and you mentioned you cover a lot of these companies, without wanting to ask you what's in your financial models, but from a sell side perspective, to what extent is this risk featuring in analysis at the moment? I mean, where was the conclusions we found about earnings calls, for example, at all a surprise, or is it really not something that's on the mainstream agenda?
On the earnings calls, I think the one comment I would make is that those tend to be focused on near-term performance. It's usually the transcripts around the industry conferences where we're talking about longer-term trends that I think that's where the conversation with management about health and wellness, because it is a longer-term strategic question, that's where that will probably fit in. But in terms of my own analysis on the sell side, I would say over the almost 20 years that I've had covering the space, I've seen two pockets of windows where nutrition and health and wellness has become a massively important investable theme, and it's moving stocks. The first period was around the genetically modified organism labeling bill in California in 2012. And I think that was where we had a confluence of the government and a lot of media coverage. You remember Michelle Obama's Let's Move campaign. We had the run up to the GMO labeling bill in California, and suddenly all the media was covering issues with packaged food, whether it was artificial flavors, artificial colors, et cetera, et cetera. And that media coverage, I think, really made a massive difference to people's choices in the grocery store. I mean, it culminated by 2014, we had Denise Morrison at Campbell Soup saying people are becoming increasingly distrustful of big food because people were so worried that promotional spending had become less effective, volumes were challenged. I mean, it was across the board, and the companies were paying attention because of that. Then the media coverage waned, and it went off the boil. I would say it came back massively last year with the GLP-1 label, the GLP-1 issue bursting onto the scene last year, and suddenly we're all scrambling to figure out what do these GLP-1 patients, what are they eating, how are they changing their behaviors, what does that mean for different food categories, what does that mean for our companies? So it comes up when behavior change is happening, and I think educating the consumer is absolutely key. I'll leave it there.
Yeah, thanks. That's really fascinating. And I think your point about sort of consumer education and then potentially the sort of the shifts that happen is a really interesting point. Lauren, did you want to sort of jump in from an asset management perspective?
Yeah, absolutely. I want to pick up on a few comments from my fellow panelists, and that is that I think as investors, we need to sort of broaden our lens of nutrition and healthy and actually look at the whole value chain of food production, because while this report focuses on the F&B players, we also need to focus on retailers, for example, the Targets of the world, the Krogers of the world, because they also produce their own private label products. They have their own marketing practices. They have their own accessibility practices. Three other key components are super quick. One is that as investors, we really need to be looking at the accountability mechanisms. So are there targets and metrics around product reformulation, not just the bad, but the good? Two, how do meeting these targets, especially around health and healthier products, influence performance and compensation? So are there links to that? And then three, marketing practices. One of the big KPIs I want to know is marketing spend to healthy products versus unhealthy, or let's say less healthy. And frankly, is there a differentiated approach in terms of access strategies and marketing to children in emerging markets and low-income communities?
Yeah, thanks. They're really interesting points, Lauren. And Frank, I wanted to sort of turn to you, maybe, ask your thoughts on the regulation issue, which is clearly something that's been coming through in this discussion, and also what both Greg and Emmanuel were saying earlier. I mean, any sort of reactions to what Lauren was saying? Any thoughts on where you believe regulation may be going sort of in the future?
No, I think what I maybe would like to add is that logically, I think there isn't a lot of information out there on what companies doing and which trajectory they have. So I think what we need is more information on the strategy and how a company recognizes the risk, but also the opportunities of nutrition. You would like to know where the portfolio is moving, but what I think is still missing, and I think it's a topic we as investors need to push on. In the end, what a company does and how the strategy is implemented is done in specific markets and countries. And I think what I would like to see from companies, how they translate a strategy, the product portfolio, to the specific regulation in a country, to the specific needs in a country, because in one country, micronutrients are potentially very important, and maybe sugar reduction is in another market. But also the dietary habits. So I think what we need from companies on the transparency side, and also therefore how they react to regulation, we need to know if they recognize it as a topic, have it integrated into strategy. Do we see on a corporate level change, and that strategy is successful? But where it in the end matters in what does a company do in the specific food environments in which they're active, including regulation, including dietary habits, but including the needs of the local consumers.
That's a really fascinating point. And it's interesting, actually, this theme of sort of understanding where companies are operating and what they're doing, I think is one that is coming through across the sustainability space. And it seems clear when you look at what the ISSB is doing, when you look at other regulations like TNFD, that sort of location-based disclosure, if you want to call it that, is something investors really need to understand the risks and the opportunities that companies face in nutrition, but in a number of other areas as well. And that, therefore, I think is something that is likely to come down the track to a much greater extent. So yeah, it'd be interesting to see if we can get more information about, as you say, the nutrition and where companies are operating. John, I wanted to sort of throw the regulation question back to you, if I may. Again, you know, you said Swiss Re might actually start lobbying for sort of forms of regulation. We won't sort of hold you on record to that, but you know, what are the sort of regulations you think would actually be helpful in this context?
So just to quickly go on that, maybe lobbying is too strong, certainly influencing, right? So, I mean, we've had a number of very big events with the British Medical Journal on nutrition. Our key audience that we try and get there are the, you know, the policymakers, the nutrition guideline people, ministers of health. So if we can get those people in a room to understand, first of all, what's happening and what the potential is if they fix things, particularly for their health systems, you know, the aim is to kind of influence and shift things at that level. In terms of guidelines, I just quickly want to go to nutritional guidelines around the world. I'm very involved with researchers and scientists looking at these guidelines. I know you use the Health Star system in your report. Many of these guidelines are quite old, and often you get kind of this grandfathering effect where whatever was said in the past is said again and repeated again and again and again, and everyone believes it as a truth. And so much of this is based on very, very poor epidemiology studies. Again, just causality, just association, right? Not causality. And the majority of the people on these committees are funded by the food industry. And so for us, it's about what is the pure view of what's truly healthy to eat. And you know, if that does shift, and we know with metabolic ill health and insulin resistance, it's sugar and carbohydrates, refined carbohydrates are really the problem. And you know, if the world suddenly begins to shift in that way, then you know, companies making their money off sugar, I think, are going to suffer.
Yeah, that's interesting. It goes back to the risk point that we've been discussing previously. Lauren, you've mentioned sort of, you know, regulation a number of times. So I wonder whether there were any other things you wanted to say on that score in terms of what you would really like to see perhaps in the near term. What would have a beneficial impact from your perspective as an asset manager?
Yeah, I'll reiterate. I think the more inclusion and sustainability standards, including the ones ATNI is going to advocate for, a core set of metrics around nutrition performance. But I'll make a play on another disclosure standard. We need a TNFD for nutrition. So we need a task force for nutrition-related financial disclosures. And I'm saying that in a sort of funny way. We're joking, but we do. We need a standard set of sort of core metrics that are being advocated not only by the standard setters but also by governments.
Always good to hear a call for yet another regulator. So you know, well-paid jobs for you and me. That would be excellent. But yes, I think you're right. Structured approach to this is really, really important. We're running up a little bit against the clock. So Alexia and Frank, if I can sort of come to you, and maybe move on from the sort of regulatory point. You know, if there was one change that you could make in respect to nutrition in the context of business and all the financial markets, or you can go back to regulation if you want, the next sort of 2 years. So, you know, one significant change. What would you be looking for, Frank? Maybe I can come to you first, and then Alexia, I'll come to you second.
Oh, that's difficult to choose from. I think what I would like to have from companies is, especially in that short term, a sort of structured risk assessment in relation to their product portfolio. Which products are at risk and are sold in countries that have regulation or have upcoming regulation, for example. And it's good to mention that regulation can be, of course, a sort of sugar tax. It can also be regulation in regards to marketing. It can be regulation in regards to labeling, like we have with the Nutri-Score in the Netherlands. So a structured risk assessment that companies would need to publish would be very helpful to bring it up on the agenda of companies as well as investors.
Thanks, Frank. Alexia, what about you?
I think that the common set of definitions of what is healthy, to echo Lauren's point, and then requiring the companies to disclose what proportion of their portfolio is meeting that guideline. But we've also got to get to the root cause of the problem, which is the subsidy question. Overhauling the subsidies on monocrops and channeling those funds into healthier ingredients, that really unlocks the whole problem. And if we could make it cheaper to make healthier food, you know, I can't wave a magic wand and make it happen in 1 to 2 years, but I think that needs to happen as well.
Fantastic. I mean, you've already raised a number of very controversial topics that we could spend a long time discussing. Lauren, briefly from you, what would be a significant thing that you would look for over the next 2 years?
We need to get investors to be asking questions in every meeting with food companies around this topic. And I really love Alexia's sort of like, what percent, you know, what is that one core metric? How do you define healthy, and what percentage of your product portfolio is deemed healthy?
And John, you'll get the final word.
I would try and get the companies to also create some kind of guide as to their future view and what they plan to change, right? So this is the portfolio currently, and this is our target in the next 1 year, 3 years, 5 years, and try and hold them to that.
Fantastic. Well, look, thank you all very much indeed for some tremendous contributions. As I say, I think there have been a number of things discussed. We've talked about nutritional guidelines, the fact they need reviewing. We've come up with a whole variety of sort of regulations, including a new regulator, potentially to look at nutrition. So a really rich discussion. Thank you very much indeed for joining. And thank you to all of you who've dialed in to watch this webinar. It will be made available on YouTube on the Planet Tracker channel shortly hereafter, so you can view it on catch up if you've missed anything or just want to see it again, or enjoy playing it at really high speed to get the funny voices. The report will also be available at around about 4 o'clock on the Planet Tracker website and on the ATNI website as well. So just remains to me to say a really big thank you to our 4 panelists, to say a big thank you to Greg and the Access to Nutrition Initiative for their fantastic collaboration on this report, and to GAIN for their support, and of course to Emmanuel Feber for the keynote address. Thank you very much. Have a great rest of the day.